I've been an accountant for 18 years. I'm also a finance expert and tax strategist, right? So I've advised over 1,000 business owners and individuals, right? And I've also advised people in all aspects of finances, from budgeting, cash flow management, debt management, credit score strategies, retirement planning, how to start a business, how to get into real estate, and different strategies like that. So that's what I've been doing for the last couple of years. I'm also a tax strategist. So as a tax strategist, what do I do? So I help a lot of high income earners save money on taxes, right? So you realize that high income earners most of them pay about 37%, about 35% in taxes, right? So my goal as a tax strategist is to help them pay 3% in taxes, right? So welcome, Dejani, right? I hope you guys had a blessed Sunday. So who had a blessed Sunday? Who had a blessed Sunday? If you're having a great day, just say yes. Say yes, 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 please. If you're having a great day, say yes, please. Say yes, 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 yes. Right? Yes. So it's been crazy the last couple of weeks. Tax season has been very, very hectic. I had so many new clients, but it's always a pleasure to help, in new clients. And even when I was on vacation in South Africa, Cape Town, I was still working. Oh dear, Cape Town was a great country. I've never been there. It was my first time. Look, if you've not been to Cape Town, trust me, you go there, you're going to enjoy life. Right? If you ask me, do I choose Dubai or Cape Town? Anytime, I'm going to tell you Cape Town. It was an awesome experience. Tiffany, welcome. So today we're going to talk about the 401k. Was it a mistake? Right? I think it's been a hot topic. It's been a hot topic. Caramel Princess, welcome. Right? Yes. So 401ks has been a hot topic of debate. People are always asking me, Jerry, should I contribute into my 401k plan? What should I do? Who is it for? Right? Why do they keep pushing it on everybody? Miss Alicia, welcome. Alicia Rose, welcome. Right? Thank you for joining. So for those who are new, right, my name is Jerry Pani. I have a master's degree in accounting and finance. I qualified as an accountant 18 years ago. I've been in public practice. I've advised over 1,000 business owners, right, and individuals. So I'm a finance expert and tax strategist for those who are still new, who don't know me, right? So I've been in public practice advising people transforming lives. So I enjoy what I do. Pioneer Jelly, welcome, right? Thank you for joining. So today we're going to have a hot conversation, a hot topic, right? I believe in education. Why? Because you realize that there's a difference between being wealthy and being rich, right? Wealthy people have all the information, and that is why they do things strategically. Are you guys with me? That's a difference. That's one of the key differences between being a wealthy person and a rich person, right? There are so many differences, but we're going to talk about, you see clearly why some people end up paying more taxes than other people. Are you guys with me? So today we're going to talk about, was a 401k a mistake, right? So I think before we get into this conversation, I think it's important to understand what is the origin of the 401k. Are you with me? So what is the origin of the 401k? Now, who here can tell me the origin of the 401k? Right? Now, just to help you, let me help you all here. So 401ks, 401ks were created almost by accident, and it started when Congress passed the Revenue Act of 1978, right, which included a provision that was added to the Internal Revenue Code, which is section 401k, right? Now, many a times people just do things because everybody's doing it. And I came to realize that many people feel comfortable, right? If everybody's building a house on sandy foundation. Everybody, because everybody is doing that, they're going to do it, and all of them are going to, their houses are going to sink. Right now in life, if you want to be successful, you don't do things because everyone is doing it. Trust me. If you want to be successful, you do not do things because everyone is doing it. That's a recipe for disaster. Right? So now I want us to look at how all these 401ks came about. How did they come about? Are you guys with me? Now it's simple. There's a guy called the father of 401k. You can check him out. His name is Ted Benner. Tedbenna. He's known as the father of the 401k. Right? So you see, before 401ks existed, there's something that we call pension plans that existed. Are you guys with me? Pension plans existed way before 401ks ever existed. But you have to understand how things evolved from pension plans to 401ks. Are you with me? Now, so Ted Benner. So let me rewind a little bit. Now, this is one of the key. This is the main difference between a 401k and a pension plan. Now, pension plans existed before 401ks. Both of them are classified as retirement accounts. Are you with me? But the main difference is that a pension plan guarantees income for life, right? So you have retirement income for life. But 401ks do not guarantee income for life. Are you guys with me? So the issue with pension plans was that these things had to be reflected in the financial statements of companies, and they took the hit, right? Whenever these pension funds went down, it had an impact on their balance sheets, right? So Ted Benner came, he says, I'll just read it out. In the late 70s, this guy called Ted Benner, he worked as a consultant to business owners whose main agenda was, how can I get the biggest tax break and give the least to my employees legally, right? So he was known as a tax nerd, right? He discovered an obscure part of the tax code, section 401k. And by 2012, nearly 75% of all company pension plans has disappeared, right? So that's how 401ks came about. So yes, they're going to tell you that, yes, I'm going to give you the employer match. But if you look at the equation, who actually benefits the most out of this equation? It is the employer, because the employer gets the tax benefits, right? Each time they are giving you all this matching and all those kind of stuff, they are getting tax write-offs out of those. So it's an equation that, favors the employer and not the employee. Because now, when you look at pension plans and 401ks, the issue is that with pension plans and 401ks, with 401ks, the risk was transferred from the employer to the employee. And that is why people are always losing money and making money in their 401ks, right? So 401ks are what we call variable accounts. Variable accounts, which means that what? If the markets go up, you make money. If the markets go down, you lose money. Now, I'm not here to tell people what to do or what not to do. At the end of the day, there's a saying that whatsoever a man sows, he reaps, right? So again, if people want to put money in their 401ks, it is fine. It means nothing to me, actually, right? Whether you put money there or you don't put money there, to me makes no difference. But I think it's important to make an informed decision. I once spoke to one of my friends and I was asking him some questions. And guess what? This guy has never logged into his 401k account. Now, imagine somebody who is just putting money in an account and he has never checked this account. What outcome do you think this guy is going to achieve? It's so important. He doesn't really care. But again, that's his decision, right? So it's important, we have to be responsible and accountable. You don't just put money in these accounts without knowing where you're putting your money. You don't even understand whether your money is growing. You see, so that's why I felt like it's important for me to educate people on these things, right? So that before you put your money there, you know that you're making an informed decision, right? I am not here to promote anything. I'm not here to promote a 401k. I'm not here to promote any account. I'm here to educate people so that they can make informed decisions. Are you guys with me? Yes, before you want to build a house, you count the cost, right? You don't just put money somewhere and hope that you're going to become a millionaire overnight or by luck. It doesn't happen like that, right? So, again, I've done some research on this subject topic. So I'm just going to present the findings of my research, right? Because I believe that if you want to put your money somewhere, you need to know what you're doing, right? So we're going to look at different aspects. I'm going to speak for those who are just joining now. Again, I'm Jerry. I'm an accountant, finance expert, and tax strategist. I've advised over 1,000 business owners as an accountant, right? I've advised people in different retirement accounts how to retire early. And again, for those who are just joining now, it's important to note that what wealthy people do is different from what middle class, what wealthy people are doing is different from what rich people are doing. Rich people make more money, but wealthy people pay less taxes, right? Rich people pay more taxes, wealthy people pay less taxes. So it's important to understand the difference between being rich and being wealthy. When you make more money, you are rich. It doesn't make you wealthy. Are you guys with me? Yes. So let's go there. I'm just going to, talk about some of the things that the results of findings of my research, right? Now, there's a guy called Kent Conrad. Kent Conrad is a former U.S. senator, and he's an expert on retirement security. And what did he say about 401ks, right? I'm not here to bash anything. I need to make things very clear, right? But I'll just say things exactly as they are. I'm not going to color code anything. And then I'm going to give you guys an opportunity to ask questions, right? So Kent Conrad is a former U.S. senator, and he's an expert on retirement security. Commies join, welcome, right? So what did he say about 401ks? Ken Conrad says that 401k plans were never designed to be the retirement plan for America. That's what the guy says. This is a former U.S. senator, and he is an expert on retirement security. I'll leave that with you. Now, there's another lady called Teresa Giladucci, right? So who is Teresa Giladucci? Teresa Giladucci, I'm just going to read. I love her titles. It says that Teresa Giladucci is a labor economist, and she's a nationally recognized expert in retirement security. She is the Bernard L. and Irene Schwartz Professor of Economics at the New School for Social Research and the Director of the Schwartz Center for Economic Policy Analysis at the New School's Retirement Equity Lab. Look, I'm not a PhD holder. I'm not a doctor, right? I'm not a professor. Now, she's a professor. She's a labor economist and a nationally recognized expert on retirement security. Now, this is what she says. She says that the 401k is a failed experiment. Now, why does she say that? She says that the 401k is one of the only products that Americans buy that they don't know the price of it. It's also one of the products that Americans buy that they don't even know its quality or know how to judge its quality. It's one of the products that Americans buy that they don't know is danger. Now, I am just quoting exactly what she said. If you want to argue, go and argue with her. I'm not a professor of economics. I don't have a PhD in economics, right? I'm not an expert on retirement security, but I'm a tax strategist, an accountant, and finance expert. So I'm going to speak from the perspective of my skill set as an accountant, finance expert, and tax strategist. and I'll look at it from a tax perspective because that's my expertise. Are you guys with me? Yes. So let's look at what other people are saying, right? We've looked at Ken Conrad, a former US Senator. We've looked at Teresa Giladucci. Both of them are experts on retirement security, right? I do not call myself an expert on retirement security. I am not, right? I'm a tax strategist. So let's continue right here. Let's look at, there's another guy called Michael Reese. He's a certified financial planner. He has so many qualifications. He's a certified financial planner. He is a chartered life underwriter. He's a chartered financial consultant. He's a certified technology specialist. He has so many qualifications. I don't even know what some of these are. Right? Now, this is what he says. Now, this is just my basic research, right? He says, the massive 401k nest egg that you're so proud of comes with some serious baggage. Now, I have just quoted exactly what the guy says. I'm not adding anything or subtracting anything, right? So I'm just going to quote exactly what he said. He said, every distribution you take will be taxed at your highest rate. So let me explain this as a tax strategist. Now, when you put money, it's important to understand that number one, 401ks are tax deferred, right? What does that mean? It means that you get the tax benefits now. Are you guys with me? You get the tax benefits now, but you are going to pay taxes at some point in the future. Are you guys with me? So let's say that if you want, some people use it for tax planning purposes, in the sense that what they don't want to pay taxes this year, so they max out their 401ks. Yes, you're going to pay less taxes this year because you've decided to put money in a 401k, but that tax is going to be deferred, right? So what is going to happen? You are going to pay taxes on that money when you are going to pull it out. They call it a distribution. Are you with me? So, which means that what? I want you to think about it. When you just start working, right? You are making less money and your effective tax rate is low. Are you guys with me? Now, for rich people and everybody else, the more money you make, the more taxes you pay, right? But for wealthy people, the reverse is true. The more money they make, the less taxes they pay. That's the difference between being rich and being wealthy. Now, so 401ks, I'm just analyzing and breaking down what this guy called Michael Reese, who is a certified financial planner, said. He says every distribution you take will be taxed at your highest rate. So it means that what? When you put money now, you're going to get a tax advantage now or this year, in the year that you're contributing, right? But you have to wait. Remember, 401ks are tax deferred. If you pull money before you're 59 and a half, you are going to pay taxes on that distribution at your rate of tax at that time. And you are going to pay the 10% penalty. And remember, each year that goes by, everybody makes more money because of inflation, right? Let's say most people. OMG, welcome, thank you. Now, so as time goes on, the more money you make, the higher your tax rate, right? That's true for everybody else, apart from wealthy people. So which means that what? Yes, you're going to get a tax benefit now, but when you're going to pull money out in the future, you are going to pay taxes on that distribution plus 10% penalty. Now that, for me, that's an issue right there. Are you guys with me? So think about it. Would you, when you start working, you're not making a lot of money, your tax rate is about 10%. But 30 years from today, you're going to make more money. Your tax rate is going to be, because taxes are expected to go up, you are going to be at maybe 30% tax rate. So would you rather pay tax now at 10%, or would you rather wait for a future at 30% and pay the taxes then? So that's the decision you have to take. Are you guys with me? Now, so the second thing, Michael Reese, he said 5 reasons why a 401k may be the worst account for retirement. This is what the guy says, not me. You can go and argue with him. His name is Michael Reese. He's a certified financial planner and he has many qualifications. Now, I'm just analyzing what the guy said. He said double taxation is often the norm. So normally Social Security is not designed to be taxable. Are you guys with me? But when you're making a certain amount of money in a 401k, you are going to have to pay taxes on your Social Security plus taxes on your 401k distributions. Are you guys with me? Now, is that a good deal? You decide, right? Now, the third point Michael Reese mentioned, he said, ready or not, you must withdraw money when the IRS says so. Whether you are ready or not, you have to withdraw money from your 401k because this account is controlled by the IRS. They set the rules. Think about it. You buy a car. Clara Jones, welcome. Right? So you buy a car and Jerry tells you you should not drive this car before 9 a.m. Are you guys with me? And then, or you should not drive this car for more than 2 hours a day. Now, is that a good deal? So when you have a 401k, you're signing away your freedom, right? Divine Shield Assurance, welcome. When you have a 401k, you're signing off your freedom. If you break the rules, the IRS says the rules, and they dictate what you do, when you do, how you do it. If you break the rules, you are going to pay tax, 10% penalty plus taxes on the distribution. Right now, from a practical perspective, as a tax strategist, what have I seen? I've seen cases where people always have emergencies, which means that they have to take money out of their 401k plans. So what is the consequence of pulling money out before you're 59 and a half? You are going to pay 10% penalty. Are you guys with me? And you are going to pay taxes at a higher rate because generally, the more money you make, the higher your taxes. Are you guys with me? Now, I'm going to continue. I'm just analyzing what Michael Reese said. I'm not creating anything. I'm just speaking as a tax strategist and finance expert. Now, Michael Reese says that it's the worst account to leave to a surviving spouse. Now, again, from a practical perspective, I have seen this because, remember, 401ks are tax deferred. So the surviving spouse, oh, this is crazy, guys. This is crazy. And you guys are going to see, I'm going to break down everything to you guys, right? So, why does he say is the worst account to leave to a surviving spouse? Number one, the surviving spouse will have to pay taxes on that distribution. And this is what happens. If you're married and one person dies, right, you're going to file CO Jordan Davis, welcome. Thank you for joining. So when you are married, right, the year that the person died, your spouse died, you are going to file as married filing jointly, right? But for 2 years after the date of decease, the date of death, you are going to file as widower, which gives you a higher standard deduction, right? But what happens is that after those 3 years, the year of death and 2 years after that, well, I think it's 2 years, yes, right? So after that, you would have to file. If you have children, you will have to file as, or if you have dependents, you have to file as head of household. But if your dependents are now old, you have to file as single. Now, if you remarry, you are going to file as married filing jointly. Now, this is the issue right here. The surviving spouse will never pull money out of the full amount out of that account because they are going to face a huge tax bill. So from a practical perspective, this is great. This is what is going to happen. In the year of death, that person is so frustrated, is going to go through probate. The 401k account and all those things is going to go through probate. So they will not have access to that account for at least 1 year, right? This is from a practical perspective. So in the year of death, you won't have, the surviving spouse will not have access to that money. Now, the following year, depending on how the probate goes and all those things. So let's say that the person died in 2020, right? In 2020, you're going to file as as married filing jointly. 2021, you are going to have access to that, to their 401k. Now remember, you will still have the advantage of filing as widower, so you are going to take advantage of the deceased standard deduction for the 2 years. But now what happens in year 3? This is where it becomes critical. In year 3, if that person files as single, this is what is going to happen. They will end up making more money, and because they've lost the standard deduction of the deceased, their income goes up, their standard deduction goes down, and they're going to face a huge tax bill. This is crazy. This is absolutely crazy. That's why I tell people, you have to know what you're doing out here. Right? They will have to face a huge tax bill. Are you guys with me? So that's what happened. I'm just analyzing what this guy said. He's not a tax strategist. He's not a tax accountant, right? So, but he just said those things. So I'm going to go to the next one. It says the last point which this guy said is that your account is fully exposed to tax law changes. Yes, when all those who have 401ks expose themselves to tax law changes. Now, who sets the rules? Uncle Sam. So if you and I, let's say that I played a football game with any of you guys, right? Gorgeous music, thank you for joining. I played a football game with you, or a soccer game, whatever game you want, or basketball, and I set the rules. Can you ever win me? Now think about it. If I set the rules of the game, can you really win me when you don't even know the rules? Now that's the issue right there. You see, so that is why you can never win Uncle Sam in this 401k game, right? Because they understand it more than you do. So those are some of the issues that I thought we should go. And then this is a summary of the key points, right? Number one, again, this is just to educate people. I can see many people joining me here. For those who are joining for the first time, my name is Jerry Pani. I have a master's in accounting and finance. I have an MBA. I'm also a fellow chartered certified accountant. So I've been qualified. I qualified 18 years ago. I've been in public practice as an accountant. I've advised over 1,000 business owners, right? And this is just for those who are just joining. So I've been in public practice. I'm a finance expert and tax strategist. I help a lot of my high income earning clients to save money on taxes, right? So I'm going to give some brief summaries about the 401ks, right? Now, with 401ks, you are always going to pay taxes. You cannot avoid taxes. You are going to get the advantage of tax deferment, which means that you are going to keep deferring your taxes, which means postponing your taxes until the day you decide to pull money out. And when you pull money out, there is a 99% probability you are going to be at a higher tax rate, which means that you are going to be paying more taxes, right? Unless if you speak to a tax strategist like myself. That's what makes a difference, right? Now, respect the key. Thank you for joining. Again, I'm Jerry, the accountant, finance expert, and tax strategist. Now, so 401ks do offer growth potential. So I'm going to look at the pros and cons of 401ks as a summary, right? So 401ks will give you tax deferment, so which means it's going to reduce your taxes now. But it's like a time bomb, a ticking time bomb waiting, because when you pull money out at some point, you are going to be at a higher tax rate, and you're going to end up paying more taxes, right? So they offer they give you tax benefits today, right? Now, the second thing I'm going to talk about is growth potential, right? 401ks can give you growth potential, but remember, if you look at the S&P 500 index, there's a market crash I have done the study, I've done the analysis. In the last 20 years, you will realize that there is a market crash every 5 to 8 years, whether we like it or not. There's a market crash every 5 to 8 years on average, right? So expect downturn in your portfolio. Now, let's look at 401ks are variable, right? So expect that you're always going to be making money and losing money. You make money when the markets go up, and you lose money when the markets go down. The issue is that nobody knows how high the market is going to go, and nobody knows how low the market is going to go. So with a 401k, you are exposing yourself to market risk and market correction. And it's going to happen in your lifetime. If you live to 80, do the average. every 5 to 8 years, there's going to be a market crash. If you live to 80, you realize that in your lifetime, there'll be so many market crashes, right? Before you retire. And before you retire, and once you are in retirement, if you live to 80, right, from 55 to, let's say 65 to 8, let's say 85 to make it simple, that's 20 years, right? Every 5 to 8 years, so you're going to have at least 3 market crashes in retirement. So the issue is there. The issue there is that from a practical perspective, as a tax strategist, I came to realize that everybody is going to need money at some point in their life for emergency. And the issue is that if your account value is down, what do you do? Are you going to pull money out of your account when it's down? What do you do? So those are things that you have to consider, right? Now, I'm going to look at the second thing of how easy is it to pull money out of your 401k. Now, there are sections in the tax code that allows you to pull money out if for maybe emergency and certain things, and then you avoid a 10% penalty. But one thing you are never going to avoid is taxes on the distribution, because 401ks are tax deferred. So whenever you're going to pull money out, that income becomes taxable, right? It's because you just deferred your taxes right there. So the main issue that I found out is that if you need that money for emergency, it's not easily accessible. I've seen many people pulling money out of their 401ks and they expose themselves to 10% penalty plus taxes. So which means that if your tax rate is 20%, at 10%, that's 30% gone to Uncle Sam, right? Now, so those are some of the issues. Now, again, 401ks go through probate. They don't avoid probate, right? I know somebody asked such a question like that. They have to go through probate. It happened to many people that I know, right? And it had to go through probate, right? So these are a couple of things that I wanted us to cover, right? I'm going to give you guys an opportunity to ask questions now, right? Somebody said, but so if a 401k is good or bad? It's not for me to answer the question, right? You have to decide for yourself. That's why I believe in educating people so that they can make an informed decision. Right. Somebody was asking, does everyone have to go through probate? Yes, 401ks go through probate, right? That's what I have seen, right? Now, so yes, they go through probate, right? Is there a way to avoid that? I've never done the research. I've never been exposed to it. So, but what I know is that I've seen many people that their 401ks have gone through probate, and the surviving spouse have had issues, but you cannot avoid taxes. Whatever you do is you are going to have to pay taxes, right? Now, again, let me look at the perspective of rich people, wealthy people, employers, and employees. So let's look at employers. I'm going to be honest with you guys. If you look at the 401k game, those who benefit the most are employers. I'm just being honest with you guys, because they get tax write-offs out of this equation, right? So employers are forever going to win. Whether the market goes up or the market goes down, they don't lose anything, right? Because they get the tax write-offs each time they are matching, giving you the employer match, right? So in this 401k equation, you see that the biggest winner is the employer. Guess who is the next biggest winner? The next biggest winner is Uncle Sam. Remember, with 401ks, Uncle Sam sets the rule. And trust me, whenever there are rules, there are going to be rule breakers. So hundreds and thousands of people have always broken the rules, and they will keep breaking the rules, and they'll keep paying 10% penalty and taxes on the early distributions. This is from a practical perspective. Are you guys with me? So you have to understand that in this 401k game, the biggest winner are the IRS and employers. Now, let's look at employees. For employees, they get tax deferment today. They get tax benefits today, but they're going to just defer their taxes. And then their portfolio is fully exposed to market fluctuations, right? So that's the issue. Now, let's look at rich people versus wealthy people. Now, many rich people have jobs, and some of them are business owners, right? There is something called solo 401k, which is like a 401k for self-employed people. Will I put my money there? Hell no. I'll never put my money there. As if you wanted to ask me that question, right? So if you want to put money in a solo 401k, which is a 401k for self-employed people, you will have to face the same problems that I just mentioned, which means that what you have to, for those who are just joining, you have to watch the recording. I'm going to post it at the end. Are you guys with me? So those are the issues. Those are the issues. But tax deferment is a time bomb that's waiting, right? So you have to make up your mind. What else do I do? What else can I do? So I'm going to give you guys the opportunity to ask questions. So let's see if you have questions. For those who are just joining, is Jerry. I'm an accountant. I'm a finance expert and I'm a tax strategist. I help high income earners save money on taxes, right? Yes. So I was going to talk about what wealthy people do and what rich people do. Are you guys with me here? Now, you will see that most people who have jobs, I do have clients making nearly from employment making over $800,000, right? And a lot of these guys max out their 401ks because that's all they know. So making money just means you are rich, but being wealthy is totally different. So rich people put money in 401ks, right? But wealthy people don't put money there. Remember, wealthy people seek professional advice so that they have all the information before they take a decision. Are you guys with me? But rich people do these things. So now, so I know you're going to ask me, so who is a 401k for? Why do people put money there if it is this good or if it is this bad? Again, it's for you to decide whether it is good for you or whether it's not good for you, right? Because at the end of the day, whatsoever you sow, that's what you're going to reap, right? Now, I've come across clients who are comfortable because that's what everybody is doing. But let me tell you something. When it comes to finances, if you do what everybody is doing, you're going to get the results that everybody is doing. That's just how it is, right? So when it comes to finances, majority never wins the vote. That's just how it is. And that explains why only 5% of people remain wealthy, because wealthy people have all the information, right? And that's why they do things strategically. Are you guys with me? Sherman, welcome. Thank you for joining. So we only have, I want us to round up in 5 minutes. So if you have a question, so the question is the 401k a mistake, right? Is it a mistake? If you have any question, just ask me. You have 5 minutes to ask your question, and then we're going to call it. We're going to round up, right? So I've covered some of the issues again. So somebody is going to ask me, so why do 401ks exist if they are this good or if they are this bad? So this is how I see it. Remember, there is no perfect portfolio. Every portfolio has a target market. As far as Jerry is concerned, 401ks are for people who don't have all the information. For me, I see them as ignorant people. I'm just being blunt there, right? Okay, right? It's your decision. But 401ks are for people who don't have all the information. 401ks are for people who feel comfortable to do what everybody is doing, right? Yes. 401ks, can I recommend a 401k? If you tell me, Jerry, I only have a job and I don't mind deferring my taxes, then max out your 401k. Then you're going to defer your taxes, right? Yes, you can use that. You can use that for tax deferment, for tax planning purposes, right? To reduce your taxes. But remember, it's a time bomb that's waiting. Are you guys with me? So again, if somebody came to me and said, Jerry, because before you want to advise people, you need to know their spending habits and things like that, right? I feel that if somebody is a spender and they're going to spend all their money, or they're going to spend majority of their money and they have a job, then it's better for them to put money in a 401k, because at least they have something, right? Because they are spending anyways, right? But for those who have all the information, it's for you to decide, right? I've elaborated extensively from a tax perspective. In this tax game, those who win the most with a 401k is the IRS, because 99% of people break the rules. Trust me, 99% of people break the rules with early distributions and all those things, and people always pay taxes. Employers are also the biggest winners in the 401k game. Why? Because all the matching and company matching and all these things are tax write-offs for the employer, right? But the employee who owns the 401k plan is exposed to tax law changes and is exposed to market fluctuations or market correction, which happens every 5 to 8 years, whether we like it or not, whether we're aware of it or not, right? So let me answer any questions. If you have any questions regarding 401ks, are they good? Are they not good? Whatever you want to do for me makes no difference. It's your decision. You decide what you want to do, right? So if you have any question, just ask the question now. We have 3 more minutes and then I'm going to close. I have a bunch of tax returns to do. Now, for those who are just joining, I can see some people joining now. Yes, my name is Jerry Pani. I've been an accountant for 18 years. I'm also a finance expert and tax strategist. For those who are just joining. So let's answer all your questions, right? Ask me any question you want or any question you have. Because once we go off the live, if you want to ask any question, you probably have to text me, right? You have my contact information. It's on my Instagram. But yes, so any question. Now, who's been enjoying today's session? If you've enjoyed today's session, say yes, please. Say yes, please. If you've enjoyed today's session, say yes, please. Okay, right. So, respect the kid. Respect the kid says, what are some of the 3 best investment vehicles to get into now? Now, that's a very, very tricky question. I don't believe, I think there's a time for everything. And for me to answer, you see, as an expert, I try to avoid answering general questions, but I'm going to give you some ideas, right? The first thing is that, number 1, you need to have a business. You need to invest in a business, right? You need to understand that, look, if you want to win the game, just do what wealthy people are doing. I'm not talking about rich people. Rich people, a lot of them, rich people just make money and they don't have the information. The wealthy people have all the information, because rich people hire tax preparers and CPAs, right? But wealthy people hire tax strategists like myself. Are you guys understanding? So if you want to win the game, my best advice is that do what wealthy people are doing, not rich people. What wealthy people are doing. Now you have to look at the portfolios of wealthy people. Wealthy people are all business owners. So if you're saying what are some of the 3 best investment vehicles to get into, number 1, you have to be a business owner. Because by using a business vehicle, you can get the biggest tax write-offs and tax advantages, right? It's the best thing to do. I will always advise you 100% of the time. So you need to be a business owner. Now, you need to get into real estate. I separate real estate from traditional businesses, because real estate generally is classed as passive income. With passive income, there are a lot of limitations, right? You need to use tax planning to avoid those limitations or to get around the limitations. That's my expertise right here. Now, start a business, because businesses are active income. You get the tax write-offs. You get a tax write-off forever as long as you have a business. Let me give you a simple example. Imagine that you claim 10,000 miles every year. It means that from the day you start your business to the day you die, you can be getting over 6,000 in tax write-offs just from mileage. Is that not wonderful? Right? Yeah, so business, real estate is one of them, right? And then there are other portfolios. Some people do stocks like Warren Buffett, right? If you are good at that, but again, I personally I've lost a lot of money, right? Even experts who said they'll manage these accounts, you still lose money. So you have to be careful. So for me, stock trading is something that you really, really have to reduce your risk. You have to ensure that you don't put more than 20% of your of your portfolio. Don't expose more than 20% of your portfolio to the market. You are going to regret it. Are you guys with me? Yes, but another one is stocks, right? For those who know how to trade. And then if you look at the Fortune 500 CEOs, again, a lot of the wealthy guys use life insurance plans as their primary retirement planning tool. If you look at it, about 85% of Fortune 500 CEOs, those are the strategies that they are using. Yes, wealthy people have understood the power of some of these life insurance plans, and that is what they use. Are you understanding? Number one, I believe in diversifying your portfolio. You cannot just rely on one portfolio. It doesn't work. You have to diversify your portfolio, right? I have set up a lot of my clients on some of these life insurance plans, and they are getting the tax benefits, right? Because remember that if you have a business, you can set up some of these life insurance plans so that it's a tax write-off for your business. Are you guys understanding? So if you want to win this game, you just have to do what wealthy people are doing. So does that answer your question? Right? The key, did I answer your question? Yes. So logs back. Yes, welcome. Right? So any more question? I'm going to take one last question. Just because I have a bunch of tax returns I need to do. Again, like I said, if you want to win the game, just do what wealthy people are doing. If you don't know what wealthy people are doing, then schedule a Zoom meeting with me, right? You can go on my website, on my Instagram. You click in the link in my bio. You can schedule a free discovery call with me, and I'll explain to you a lot of the strategies that wealthy people are using, and that will transform your life. Now, don't come to me, to Jerry, and waste my time. Don't come to me and expect me to be telling you about traditional accounts, because wealthy people don't put money in traditional accounts. I guys with me? There's a difference between being rich and being wealthy. Wealthy people do not put money in traditional accounts. All these IRAs, all these 401ks, and all those crazy things. Because if you want to win the game, if you want to win a football game with Uncle Sam, you need to understand how Uncle Sam works. You need to understand the rules. You have to create your game that you set the rules. That is how you beat Uncle Sam. But if you put your money in accounts that are managed by Uncle Sam, you can never beat Uncle Sam. Are you guys with me? If you want, there's a guy who says that you have to build your own economy. You have to build your own economy. You have to build your own tax world. A world that you understand your game, and that is how you beat Uncle Sam. And that only comes through expert advice. Like I said, if you have any question, go on my business website, Tax Plan Strategist, and schedule a free discovery call with me. And I'll see. Again, I don't like giving general advice. I ask a lot of questions about your portfolio, then I give you the best advice. Right? So, any other question? Right? Any question? So it's been a pleasure having you guys. Thank you for joining. And again, I'm going to continue with my trend of having Instagram lives every Sunday, right? And educate people on things that nobody's doing. Educate people on things that everybody should know about these things, right? We're going to talk about different things of taxes, right? And then at times I'm going to do diversions and talk about other aspects of life, right? I like to talk about everything. So you guys have a blessed Sunday. And we'll see you next Sunday by the grace of God. You guys take care. Peace.